Right. Okay, semua boleh nampak screen eh? Can you all see? Tak ada jawapan pun ni. Can you all hear me or not? Jawab boleh dengar saya ke tak ni?
Boleh.
Okay, right. Right I see 24 of you including myself, ada 23, ada 2 lagi tak masuk alright, Nadia ada?
Ada doktor.
Ainin, Sofia,
Ada doktor.
Islam, Islam ada? Okay, tak jawab, tak ada. Hafsah?
Ada doktor.
Alright, Izan? Izan Sadimin, you there? Kalau mic
ada,
tak boleh
madam.
guna, you can. Okay, ada. Boleh jawab dekat chat Lalu, ada sebab tadi dah jawab. Shillong, you there?
Yes, doktor.
Alright, Najmin,
Ada, doktor.
Natasha, Natasha, you there? Nazrin,
Saya doktor.
Noreza,
Saya.
Noraisha, Nur Nabiha,
Saya doktor.
Shazwani,
Saya doktor.
Jazlina,
Saya doktor.
Nailia,
Saya doktor.
Shanabil,
Saya, doktor.
and Siti Noraisha,
Saya doktor.
Enfa,
Saya doktor.
Darshini,
Yes, doktor.
Toshania, okay, so you unmute tapi suara tak keluar. Wan Khairul Hakim, okay, I cannot hear you, Wan. Wan Nurul Rashika,
Saya doktor.
okay, tak apa, it's alright, okay. Alright, so for today we're going to continue with derivative market, and it's quite lengthy juga topik ni, and later on I will share with you the parts or the things that you have to read for this derivative market. Okay, what we have done previously during the previous semesters, I actually invited one of the bankers to come and talk to you about derivative market, but for this semester I think I will do it myself, but I will leave I think towards the end of the semester kita ada one topic which is on bank regulations. So I think for that topic I will invite one of the bankers to come and talk to you, to give lectures on that particular topic, but not derivative markets. So for this one you can also read. All right, so when we talk about derivative markets, and if you go to our course outline, you can see that we are actually learning about, first of all, we have money market, and then we have money market also for the exchange market, and then we are talking about capital market before celebrating our Hari Raya, and then for today we're going to look at derivative market, and after derivative market we have offshore market. Right, so basically those are the markets that we are going to cover throughout the semester. All right, so for this derivative market, I try to make it short because I think 1 hour cukup lah kot before this topic. All right, so we are going to look at the concept of derivative markets, the development, the derivative products and the underlying instruments, the structure, the participants and the type of derivative, and also the difference between futures and option, and also forward and futures. So basically those are the things that we need to learn when we talk about derivative market. So first of all, we need to know what is derivative market. All right. So when we talk about derivative, the keyword here or the root word here is derive, which means based on this market, the price of something is derived from something. Means that the price or the value of certain instruments are actually derived from other assets. So for example, here when we talk about derivative market, it actually facilitates the trading of the financial derivative instruments. So there are the different types of derivatives, and we're going to look at that later. And then when we talk about derivative instruments, so the keyword here is instrument, and we're talking about financial instruments. So before this, kita dah tengok the money market, the money market instruments. So here we also have financial instrument, which are the example of derivative. So like I said, the root word is derived. So here when we talk about financial contract, because we are focusing on financial instruments, the one that gives us financial value. So when we talk about financial contracts, the value depends on the value of other basic underlying assets, which means the value of for example, the value of crude palm oil, okay, is depends on the palm oil price. So crude palm oil, CPO, kalau you tengok in the bursa, they call it CPO, crude palm oil price. So harga minyak kelapa sawit. So it is a commodity, and the price depends on the palm oil price itself. Okay. So we have a commodity price. So commodity, for example, we have CPO, crude palm oil. Commodity also include different types of oil, corn oil, and then it can also be coffee. Coffee is also types of commodities. And then it also include interest rates, okay, interest rate index, and also share price. So later we can see the different type of derivatives. Okay. It exists to provide medium for the industry to manage risk exposure to interest rate and also currency. So you can go back to your previous notes when we talk about interest rate and also currency rate. And for derivative market, it is settled at a future date. Okay, it is not settled today. For example, okay, we enter into contract today. Let's say, okay, I enter into contract with you and then I want to buy something in the future, but we lock the price now. We lock the price now, tapi benda yang saya nak tu will be settled ataupun kita akan deliver at the future date, not today. So we call it kita ada nanti the different types of contract, forward and also future contracts. So the objective is actually to reduce portfolio risk, because for example, you do not know, for example, for palm oil price, we do not know how much is the palm oil will cost us, especially during Ukrainian and Russian war last time. So tak ada, kita tak ada specific ataupun the fixed price. So you want to make sure that you're not going to lose a lot. So you can enter into a contract now to deliver or to buy something later. That is why it is settled at a future date. All right, so development of derivative markets. All right, for derivative instruments, different countries, they have different instruments. For example, in Malaysia, we only focus on commodity derivative and also financial derivative. Okay, but equity derivative. For example, in the US, they have financial derivative or currency derivative. So kita tak ada lah. Right, and then derivative products, for example, here we have futures and options, mostly traded in bursa. Okay, and kita ada Bursa Malaysia Derivative Berhad. It is an exchange for trading of derivative. Right, we have Bursa Malaysia to trade all the shares, but for derivative, it is done under Bursa Malaysia Derivative Berhad. So I think I will skip the history part ni. You can read the table ni. Tak ada apa, just the different dates je. Alright, so again, the structure of derivative market in Malaysia quite similar to what we have looked at so far. So on the top is the Minister of Finance, and we have Securities Commission. So under Securities Commission, we have Bursa Malaysia Berhad, and we have Bursa Malaysia Derivative and Bursa Malaysia Derivative Clearing. So what we have looked at so far for capital market, we focus on Bursa Malaysia Berhad. So for derivative, dia ada lagi satu Bursa Malaysia Derivative Berhad. So these are the different products that is offered under Bursa Malaysia Derivative Berhad. Okay, this is what I talked to you before. CPO, crude palm oil futures, crude palm kernel oil futures, stock index futures, stock index options, futures and futures lah. So MDS. So here we have despite yang benda-benda palm oil ni the commodity derivative, right? The stock and the futures ni, the MDS ni is the equity derivative. So dia bukan commodity, the equity. So for Bursa Malaysia Derivative Berhad, 75% own subsidiary of Bursa Malaysia Berhad lah. That is why they use the same name, Bursa juga, Bursa Malaysia Derivative Exchange. So our Bursa Malaysia Derivative operate the most liquid and successful CPO futures contract in the world. So when people talk about palm oil, they are actually referring to Malaysia, and Malaysia set the CPO price. And it operates under the supervision of the SC, governed by CMSA 2007. And Bursa Malaysia Derivative also falls under the jurisdiction of Ministry of Finance, and the chart that we looked at before. We also have Bursa Malaysia Derivative Clearing House. Okay. So this clearing house clears and settles all the derivative contract through derivative clearing and settlement system. Okay. So when we talk about clearing house, they actually support all the derivative clearing lah. Okay, so this is what we're going to look at, the different type of derivatives products and underlying instrument. That is why the derivative, I said the product and the price derived from underlying assets. So here when we talk about CPO, crude palm oil futures and FCPO, the underlying instrument or commodity, and so the price of CPO depends on price of crude palm oil. So the higher the CPO ni, the higher the FCPO ni, alright? And then derivative product, we also have KLCI, Kuala Lumpur Composite Index. So this is equity derivative, and the underlying asset is KLCI. So this is equity derivative. Samalah dengan index option. 3 months KL Interbank offered rate interest rate futures. This is CLIBOR. 3 months is the underlying instrument. We also have 3-year MGS. So underlying instrument is 3-year MGS. So basically, if you look at the product and also the underlying instruments, they are quite similar. Okay. So we also have crude palm oil kernel. So the FPKO depends on CPO kernel price. Okay, so these are the products, these are the underlying instruments. So the price of this product depends on the price of this underlying asset, instrument or asset. All right, who are the participants? We want to know when we talk about money market. We want to know who are the participants. So kita tahu kita ada brokers, kita ada investors. So when we are dealing with derivative market, we want to know who are the participants of derivative market. So the participants use this future market to minimize their risk and also to reduce their cost of doing business. So again, whatever, if you can see throughout the chapters, whatever product under this financial institution, the objective, the main objective is actually to minimize the different types of risk and also to reduce the cost of doing business. So in whatever things that business do, what want to do is that to try to minimize the risk and to reduce the cost of doing business. So this is what derivative market do. So it is also to be used as risk management tool by market participants or investors to safeguard the investment in anticipation of uncertain future market direction. Okay, the concept of this derivative is that you enter into a contract today and you lock the price today, but the delivery will be done in the future. So along the way, you expect the price to go up. Okay, so let's say you pay or you enter into contract today. Let's say you want to buy CPO tadi tu at a price of $500 per barrel. Okay, so you lock 500 today. You expect the price will go up in 1 or 2 months time. You expect the price will go up. Why you want the price to go up? Because you need some profit. So you only have to pay 500 during the delivery. But let's say the price goes up to 600. So you dah untung dah 100 dekat situ. So you get profit. You can also make sure that if let's say the price goes down, then that's the risk that you have to take as well. Alright, so the participants of derivative markets, we have commercial banks, right? So you all have one of bank as your assignments. So you can see, you can read in their notes to the accounts, you can read the front page, what have they do. They also have derivative in their financial statements. So they use derivative to hedge against interest rate risk and the fluctuation of interest rate. Fund managers, okay, we have fund managers, they hedge portfolio against stock market and interest rate fluctuations, right? So they hedge, they try to make sure that they won't lose much to speculate. Okay, so fund managers, they also a speculator on future stock market or interest rate movement. So they use this future to hedge the portfolio and also to speculate. Securities firm, they to hedge their own portfolio against stock market and interest rate movement. So this is what they have done to minimize the risk and to minimize the whatever loss that they might get. Pension fund, so here in Malaysia kita ada approved pension fund, for example EPF. So EPF also one of the participants of derivative market to hedge portfolio against stock market and interest rate fluctuation. So you see the purpose is actually again to manage their interest rate risk. And also insurance company, same thing with pension funds, institution, they try to manage their interest rate risk. All right, so the participants of derivative markets can be divided into 3. Okay, we can say that, okay, there are 3 types of participants. One is called hedgers, one is called speculators, another one is called arbitrageurs. Okay, what hedgers do? Hedgers wants to protect the value of their portfolio. They want to protect the value of their investment. So they hedge. Okay, not necessarily they will make profit. Okay, but the main objective is to protect the value of their portfolio. Speculator means speculate. When you want to speculate, when you speculate something, you want to make profit. Okay, sama dengan arbitrageurs. They also want to make profit. Alright, so kita nak tengok one by one. For example, for hedges ni. Alright, so the main objective or the purpose of hedges is actually to protect their value of investment or their portfolio. So what they do is that normally corporation and investors use this hedging technique, or this is also called a risk management tools. Later on, I think you will learn, you have one subject called risk management. So you will learn a lot about, I'm not sure whether hedging is one of the topics in risk management subject, but hedging is one of the tools to manage the risk. So it is used by corporation and investors to minimize or mitigate risk on exposure to market volatility. I think by now, all of you have understand when we talk about interest rate risk, when we talk about market volatility, when we talk about different factors that affect the foreign exchange rate, the different factors that affect the interest rate. So one of the ways to manage the risk is actually to involve in derivative market as hedges or hedging. So to immunize from unfavorable price movement in the underlying asset, so they protect from price increase and etc. So again, when they involve in derivative ni, for example, the forward contract tadi tu, so they enter the contract today with a hope that the price will go up. So they want to protect, so that bila they lock at certain price, they will manage the unfavorable price movement based on their underlying asset, because we're talking about for investors and also corporations, and we're not talking about small amount of money. They hedge billions of ringgit, so they have to be careful. How to hedge? Okay, sebut hedging. How to hedge? What is hedging and how to hedge? All right, so for example, an intended share seller, all right, will concern about the falling share value in the future. Okay, I purchase shares a lot, but I don't want my share value to go down. Okay, so what I will do is that I will try to establish a selling ni kita kata short hedge, selling, to ensure the exposure of holding physical shares is well protected. Okay, so what they do, right? So here kita dah nampak the concept is that a share seller, they don't want to, their concern is that they don't want the share value to go down. So they establish a selling or short hedge. Okay, how does this work? Okay, for example here, so again when we say sell, it is short. Kalau buy, this is the term under that is used under bursa. When they say sell, it is short. When they say buy, it is long. So when we talk about selling, so it is a short hedge. So tadi the concept is that this manager ni they anticipate this BMSB Bursa Malaysia is to experience another downtrend between today, it's supposed to be May, now May, and near future September. So dia dah agak okay, from May until September ni there will be a downtrend in Bursa Malaysia. So maknanya the price will go down. And what they want to do is that, okay, so for example, now KLCI is at 1,200 and in September futures would be 1110. Nampak the point turun kan? So another downtrend. So what they are trying to do is that they manage a portfolio. This manager ni, they manage a portfolio worth 100 million and decide to hedge 80% of the portfolio. So can you imagine if this person or this manager do not do anything? The portfolio worth 100 million. So dalam masa 3 months, the share price will go down. 100 million ni tak jadi 100 million, it will go lower than 100 million because of the market will go a downtrend. Okay, so what they try to do is hedge semua. Can you imagine, let's say they hedge, dia anticipate akan turun. What happen if naik so rugilah. So dia tak hedge semua, they hedge 80% je. As expected, cash index closed at 1160 and future index at 1050. So apa yang they anticipate is true. So, right, so today or June or May, so cash market tadi kita kata 80%, manage 100 million, see, bukan 100 ringgit, 100 million portfolio, and they hedge 80%, which means 80 million of the portfolio. And here current index is 1,200, they expect index to fall. Okay, so this is cash market, this is now. So futures market pula, opening position, sell 1657 September, FKLI futures at 1110. Okay, the futures market ni. So September later, after 3 months, he can sell the 100 million of portfolio at lower price, falling index as expected to 1160. So to make sure that they can hedge this 80% ni, so the offsetting position, they will buy 1657 ni, September FKLI futures at 1050. So here, this is what they do. Okay, so today they nampak the price will go down, so they hedge 80%. Right, so when September comes, dia tak adalah rugi teruk sangat because index now is 1230, they enter into future market at 1110. So kalau dia tak ada buat apa-apa, index ni 1200, and then by September jadi 1050, but now dia dah lock at 1110. Okay, so tak adalah loss banyak sangat dekat sini. So this is what happen if the price goes down. They also have to take future position as a substitute for the later transaction in the spot market. Okay, spot market is now. Kita buat hari tu kan, kita tengok the price for forex. So spot market is now. So for this anticipatory hedging, trader will take a futures position substitute for the later transaction in the spot market. We check. I was supposed to explain to you on forward and futures forward. Then only you can see what does this means. Forward. Okay, tak apa. So anticipatory, anticipate when you expect something to happen. So trader will take a future position as a substitute for the latest transaction in the spot market. For example, in May, a portfolio holder expect to receive funds of 2 million to be used to purchase additional shares in 4 months' time. Okay, now dapat now 2 million to purchase shares in 4 months' time up to September. And the current portfolio of shares is 15 million. Share market drops and he is of opinion that shares are cheaper now than in 4 months time. So when he receive the funds, dia akan receive the fund in September. So in that case, dia masuk dalam kategori long hedge or buying. So hedge against a rise in share market by using KLCI FT to lock in a favorable buying price by buying KLCI future. So for derivative ni, they have 4 contract months to choose. This is fixed. May, June, September, December. Okay, so they can choose September as it coincides with the timing of the anticipated cash transaction. So later on, when we look at forward and also future contract, so maybe you can make sense of this. Buying long hedge. Right, so in this case, market maintains steadily rising trend throughout the following 4 months. So he will hold the contract until maturity on last business day of September. Okay, so this is an example. Can contract automatically close out by an offsetting sale at 1195 closing price for September contract. Itu hedges. What they try to do is that they try to minimize their risk, and they try to protect their portfolio or to protect their investment. Alright, for speculator, they not speculate. So the objective of speculator is to make profit. What they try to do is they attempt to make profit from price movement in underlying assets. So hedges study, take future position, they beli siap-siap or they lock into a future contract to hedge their risk, nak minimize the risk. But speculators ni biasanya they take the opposite position. Why they take the opposite position? Because they want to make profit. They also provide liquidity to the market. So who are these speculators? And we want to know who are these speculators. So these are risk takers. So they are the trader who motivated and attracted to the market in view of profits from volatility of the prices. So we can see, so when the price goes up and down, the market is volatile like now, harga tak tentu, kejap naik, kejap turun, so they want to speculate. So if the market moves in their favor, they earn huge profit. But if the market moves against their expectation, they suffer losses. So these are the risk taker. They are exposed to high risk in view of their position as long-term trader. Okay, who normally hold derivative contract for more than a week, and they are willing to take risk that hedges seek to avoid with the compensation for higher return. Kalau macam hedges tadi, dia tak nak rugi banyak, so they enter, dia price dapat lower price pun tak apa, as long as dia tak rugi banyak. But speculator, they don't care. They are willing to take high risk, because as we all know, high risk gives high return. But if the market move against their expectation, they suffer loss lah. So speculators bukan main speculate je, they have to do research. So they accept risk motivated by profits. They want to make profit. So they do not wish to own any physical palm oil. Those buying and selling only contracts and not the physical commodity. Okay, that's the difference. They need, it is also like money market. It's just a piece of paper, a piece of contract, and not the physical commodity. Dia tak ada ambil emas jual beli, tak ada. Contract je. So they buy futures when they expect price to move upward. Pasal kan, kita beli something today, kita beli futures today, future contract, when we talk about future here, these are actually futures contract. So we'll go to futures contract later. So here, when they buy futures, they expect the price to move upward. So they buy today, lower today, murah hari ni, and sell high later. Or they sell futures when they expect price to move downward. Or they kata, oh ni, this futures contract ni, the price will go downward. So I better sell today. So I sell higher today. I buy at lower later. Later bila harga turun, dia beli. So dekat sini lah. Bila dia expect price to move downward, dia beli. No, sorry, price to move upward, dia beli today. Tapi kalau dia expect price to move downward, dia akan sell today. So these are speculators. So untuk speculator pun we have two different types of speculator. Ada day trader, ini lagi teruk. Attempt to capitalize on price movement during a single day. One day saja, during market open 9 to 5 tu. They try to capitalize, they try to make profit as much as they can. And usually they close out their future position on the same day the positions were initiated. Dia buka pagi, dia tutup petang. Okay, dia jual pagi, dia beli petang. Or dia beli pagi, dia jual petang. Day traders. We also have position traders. Okay, ni simpan lama sikit. Maintain their future positions for longer period of time, weeks or maybe months. They want to capitalize on expected price movement over a longer time horizon. So bersabar sikit lah, they are more patient than these day traders. Day trader ni, they attempt to capitalize during a single day sahaja, the speculator ni. Alright, so for example, this is a speculator speculating interest rate futures contract. Speculate, so on 22nd April, the speculator forms a strong opinion that interest rate will decline based on his or her research and also the trend, whatever, the fundamental analysis and everything. So he wished to profit from it. Okay, the interest rate will decline, so they nak profit. And buy 10 June Libor futures contract at 94.52. So let's say their punya initial margin is 10,000. So on that day, the market closed at 94.43. So still there the variation loss lah of 2250, and the difference between 9443 and also 9452. Ini yang dia beli so harga turun kat sini. So for speculative trading position ni, where the trader take a view on the likely movement of future price, it can lead to large profit or losses depending on whether the trader gets it right. Nama pun speculator kan, they want to make profit, but at the same time the higher profit they get, they also can get a higher loss. So speculation is risky due to the volatile price in the future market combined with leverage. Okay, the third one is arbitrages. Arbitrages pun tadi the purpose is to make profit. Okay, so these arbitrages, they take advantage by simultaneously selling and buying of the same underlying asset at different market. Okay, simultaneously. So that's the difference. Tadi speculator start dia bukan simultaneously, dia tunggu bagi day ataupun longer period lah. But for arbitrages start it can be done simultaneously. So for example, buy from market A with lower price and sell it in market B with higher price and get a positive return. So arbitrages ni. Alright, for types of derivative market, kenapa ada satu je dalam ni? Right here, so for this type of derivative market ni sebenarnya for in this case, I think sepatutnya I write here two types terus. Kita ada two types, satu is exchange traded and another one is over the counter. Ada number 2 kat sini saya tambah sekejap. Ke number 2 duduk dekat tempat lain. What is exchange traded? Okay, never mind. Kita tambah dekat sini. Okay. Number 2 is actually over the counter. Or we call it OTC. Alright, so for organized exchange, it can be organized exchange traded. So you can update your note. I prefer to use the term exchange traded. So here termasuklah futures and options, and it is established and also traded with standard terms. And traded over Bursa Malaysia Derivative Berhad. For over the counter, it's not. There any transaction credited by two parties anywhere else. Anywhere else. So here, number 1, exchange traded ni must be done through Bursa Malaysia Derivative berhad. But for OTC ni can be done, created by two parties anywhere. Okay, not necessarily in Bursa Malaysia, in Bursa derivative. Right, so two types. One is exchange traded, another one is over the counter. Okay, so these are tadi dekat depan tadi awal-awal tadi when we have this all the CPO and everything, and those are actually commodity derivative. Commodity derivative. But here we can classify these as financial derivative. So whatever financial instrument and the finance asset that give financial value, so can be categorized as financial derivative. So for example, here we have forward contract, futures contracts, option contracts, and also swap contract. So the underlying instrument, it can be commodity price. For future, it can be stock price. For options, it can be exchange rate. This is for foreign exchange, and the option. Swap contracts, it can also be interest indexed. Okay. All right, so if we go back to these two types of derivatives, organized exchange or exchange traded and over the counter. So here again, nama pun exchange traded must be done by Bursa Malaysia derivative. So they are the standardized contract. You want to enter into futures contract, you want to enter into option contract, they ada standardized contract. OTC is more complex. So in this case for OTC ni, a financial intermediary, biasanya banks, they will find a counterparty or they serve as a counterparty and they tailor to the counterparty's requirement. So the contract is non-standardized and the delivery month pun non-standardized. Yang tadi ni kita ada May, September, December tadi but this one no. This one it can be any time of the year. So the delivery month it can be any time. Alright, ini baru masuk forward contract. So there are two types of contract. One is called forward contract, another one is called future contract. But both are actually involved or happen in the future. Nama dia forward, but ada sedikit different in the contract. Alright, so for forward contract ni, it is an agreement between two counterparties that fix the terms of an exchange that will take place between them at some future date. So the contract happen at, kita kata time zero. Time zero is now lah. Agreement at time zero to exchange asset for cash at a future date. So again, I promise you to buy crude palm oil today. Okay, we enter into contract today ni, kita sign contract. Okay, saya nak beli crude palm oil, gunakan this for contract. So the derivative, the instrument is, the underlying instrument is crude palm oil. So kita pakai FCPO tadi, nak beli FCPO, gunakan price of CPO tadi. Okay, we enter into contract today and saya nak beli ni and you will deliver to me the CPO in 3 months time. Lagi 3 bulan. But we lock the price today. Why? Because I don't want the price to go up and down during these 3 months. Masa panjang, a lot of things can happen. So I lock the price today. Or it can also be that I have no idea what the price will be in 3 months time. Okay, I don't know what the price will be, naik ke turun ke, I don't know. But what I know is that I want to buy today with this price. Okay, $500 per barrel contohnya. Okay, I want 500 today. So carilah parti yang mana berminat dengan my price tu. So we enter into a contract. Sign today, price of 500. Forward delivery. Maksudnya the delivery will be done in 3 months time. So in the contract ni, akan specify lah what is being exchanged. Okay, the CPO tadi. The price, how much? 500. The date, 30 September contohnya. Alright, so it is very clear. You must, it will have all the details, the underlying asset dia apa, the future date dia apa, the start of the contract tu bila, the date, enter into contract today ke besok ke. The quantity, the quality, apa lagi ada, the delivery logistic, okay, bila nak dapat, time, date, place, and also the price the buyer will pay at a specific time. So very detailed lah dalam contract tu for a forward contract. It is a tailor-made contract. So again, because of the information that I told you before, there are the date, the time, the logistic, the place, the price. the quantity, the quality. So it is a tailor-made contract. Cannot be cancelled without the agreement of both parties. It is not liquid, not marketable. No guarantee that one party will not default. So it is traded OTC. Remember OTC tadi, there no standardized contract. So this is a tailor-made contract. So forward contracts can be traded OTC, over the counter. So for forward contracts, it is normally used in international market for different types of product. For example, precious metal and stone, gold. Okay, it can be under forward contract. Grain, oil, coffee. Coffee pun masuk dalam forward contract. Natural gas, beef, orange juice, electricity. So those are the thing, or kita kata products that involved in this forward contract. So the difference between forward and future, because later on kita nak tengok futures contract. Forward contract ni, the difference is that it is more flexible. For forward ni more flexible. Like I said tadi, dia boleh jadi grain, oil, coffee, juice, beef, electricity, gas. For forward contract, flexible. But for future contract, dia standardized. So future, dia tak boleh simply whatever product that you want to sell, you nak pakai forward contract, tak, nak pakai future contract tak boleh. You have to use forward contract because forward contract is more flexible. So again, kita tengok tadi oil. I give you example for forward contract is oil. Okay, it can also be, for example, when we have a palm oil estate owner, right? So for palm oil, oil palm, the tree is called oil palm. the oil is called palm oil. So for example, for an owner, estate owner, they will harvest the fruit, fresh fruit bunch too. Let's say they akan harvest in 6 months time, and they want to sell the fresh fruit bunch tu untuk buat oil. But he or she does not know how much the price would be in 6 months time. So dia tengok buah ni, I cannot pluck now. I have to wait for 6 months. I want to sell this fruit, oil palm fruit ni. I want to sell the fresh fruit ni in 6 months time. But I do not know how much will be the price will be in 6 months time. So dia nak jual tapi dia tak nak harga price berapa. So what he wants to do is that he wants to lock in price now. Nampak tak? In 6 months time dia nak jual, but dia tak tahu harga berapa dia nak jual. So he wants to lock but he knows the price now. So he wants to lock the price now to make sure that tak ada loss whatever lah in the future. So when, for example, when he wants to lock the price now, dia bolehlah cari buyer buat contract, forward contract with a buyer. So for example, buyer ni nak beli RM20 per metric ton, okay, in 6 months. Ada buyer nak beli dengan harga tu. So the contract akan letak lah, okay, how many kilos, the quality of the fruit, the terms, the method of settlement, bayar cash ke apa ke. And then under the forward contract ni, so the owner tadi agree untuk bagi the specific quantity. For example, tadi kita kata dia nak bagi berapa kilo or berapa ton metric of the fruits tadi in 6 months time. So they use forward contract to eliminate the price risk. So whatever happens to the price, naik ke turun ke, they are safe. Okay, because they lock the price. It's just that maybe the result is that maybe the estate owner will be happy lah kalau price tu memang follow whatever they agree. They agree at RM20 tadi. If in 6 months time the price is going to be happy. So orang kata nak 20, so this is what they want, and the buyer pun happy. But if the price, the cost end up higher, so kalau the price end up higher, so the profit of the buyer tu kurang sikit lah, because they lock at 20, tiba-tiba after 6 months the price jadi 23. So he has to pay more. You already entered the contract at 20, tapi harga naik. So the price after 6 months is 23. So dia rugilah, dia kena bayar lebih lah. So but if the price turun, So they akan the opposite will happen. So that is why in certain cases the owner prefer to engage in forward contract. The lock the price siap. But the risk of this forward contract or the challenge is that to find the counterparty to buy. So that's the risk. Alright, so kita tengok tadi the difference between forward and future. Forward is more flexible because it involve a different more types of products compared to futures contract. So futures contract, agreement between two counterparties to buy or sell specific amount of underlying asset at a particular time in future for a predetermined price. The future price. Future price. Tadi forward price now, but future, nama pun future for the price in the future. So the delivery, the payment will be done in the future at a specified future date. So it also allow you to lock in fixed price today for a product that is to be bought or sold at a later date. The difference between futures and forward tadi the price is locked, fixed today. Kita enter into contracts, the price is fixed today. But for future contract, tak. Future contract ni it can be, we call it mark the market. So mark the market. Kalau forward tadi kita fix let's say tadi in 6 months time kan dah fix at RM20. So whatever happen in the price change, naik ke turun ke, doesn't matter. Kita tunggu sampai 6 month period, then only berlakunya the delivery. But for futures contract, no. For future contract, they adjust market daily. So let's say enter into future contract for 6 months, it can be adjusted daily, right? For 6 months time too. So for this future ni, dia tak fix lah over the life of the contract. It can be changed ataupun kita boleh mark to market daily. So the contract price is adjusted each day as the price changes. Because the main difference is that for forward tadi we lock the price now. So whatever happens, we don't care. We just use the lock price now. But for futures ni, the price is actually at the future. Kita kata tadi future price. So future price, it depends lah. Let's say besok harga berapa and then we follow that price. So dia tak fix. Dia follow je the price sampai lah at the end of the contract. And for futures contract, in Malaysia we have like I mentioned before tadi lah, we have commodity derivative, we have equity derivative and also financial derivative for futures contract. So again, because future contracts are traded on bursa, this is exchange traded, so there are the specific settlement date, specific delivery date, March, June, September and December. And futures are traded on Bursa Malaysia. Forward tadi tak, forward tadi OTC. So features, since it is a standardized contract, the features pun it is standardized lah. The quantity, the quality, the time, legally binding agreement all standardized. It also allow buyers to receive and seller to deliver an underlying asset sometime in the future. The only negotiable for is the price. Okay, the date, the time semua no, fixed. The price yang follow every day. Okay. So again, buyer, also known as long position, okay, buy long, sell short. So buy the commodity or asset on the settlement date. Rise in the market price of the commodity or asset cause their margin account being credited. So the user of the commodity or buyer of the asset who needs to insure against the rising price will enter into the position to hedge using the futures contract. And individuals who believe that the market price of the commodity or asset will rise choose to enter into the market to speculate the commodity or asset, and they will act as speculator. Right, seller, short, sell short, short position, delivery the commodity or asset on the settlement date. Okay, then they buy and buy on the settlement date. This one they deliver on the settlement date and they sell on the settlement date. So there is the opposite lah, satu buyer, satu seller tadi. And individual who believe the market price of the commodity will fall choose to enter into the market to speculate the commodity or asset, also again act as speculator. Types of order placed in futures market. So futures market ni more complicated than forward tadi lah. Forward tadi quite simple and less complex. Alright, so type of order. Again, if you look at futures market tadi, kita kata dia exchange traded, dia standardized. Dia trade on Bursa Malaysia derivative. So for the market, the different types of order placed in future market, we have market order. Orders placed for immediate execution when trader wants to initiate or liquidate a position. No price attached to order, can sell or buy at market price. Limit order. Only be executed only if the price is within the limit specified by the customer. And also stop order, used to stop loss. Ini pun kita dah belajar sebelum ni kan, ada stop loss strategy. So if you reach certain amount, certain price, then you stop, okay? To stop the loss, to protect profit or to initiate strategies based on psychological price level. Okay, this is something quite vague. Selagi you do not enter into that particular contract, so you don't really get, because this is involve a contract, a piece of paper sahaja, not the real product. This is steps involved in trading futures. Alright, so for example, if you want to involve in trading futures, so place a limit order to buy a particular future contract. This is limit order. Limit order tadi apa? Limit order tadi only if the price is within the limit specified by the customer. So this customer specified that price is not higher than RM3. Okay, so place an order to sell a future contract if it is priced not lower than a specified minimum price. For example, 550 pun boleh. Okay, ni limit order. To buy kalau tak lebih dari RM3, or nak sell kalau tak lower than RM5.50. Okay, so this is limit order. So the settlement, it can be a close-up position by entering into the opposite trade, offset lah, or perform the contract by final cash settlement when the contract matures. So can settle anytime or can wait until the contract matures. For forward tadi different, forward kena tunggu the settlement date. Close out on the future position. So buyer and seller of financial future contracts may offset the positions by the settlement date. So for example here, speculator who purchased treasury bond, future contract could sell similar futures contract by the settlement date. Okay, so closing out, the gain on loss, we were talking about gain and loss here, depends on the future price at the same time of the purchase versus the future price at the time of sale. So it can be a positive gain. So the price of security has risen over the period. So speculators who initially purchased the future contract were likely to have paid a lower future price. And negative, kalau the price have risen over this period and all the early contract to sell future will be priced lower, right? Alright, we also have financial futures contract. Tadi kita tengok financial derivative pula. Commodity and also equity derivative. So here financial futures contract includes stock index future contract or FKLI, and also 3 months LIBOR futures. So this is the interest rate. Kalau LIBOR futures ni is the interest rate. Yang atas ni is the equity lah, stock price. Alright, we also have option. Remember tadi kita ada futures and options. Options contract give the owner the right but not obligation. Nama pun option, contract that gives owners the right to buy or sell at a specified amount of an underlying asset at a specified price on or before a specific day in the future. Okay, if holder or option buyer choose not to buy or sell the underlying instrument or commodity, they can let the option to expire with a price call premium. So option, dia ada option untuk buy or sell at a specified price on or before a specific day in the future. Tadi future dah ada date, forward pun dah ada date. Option ni, dia ada date but it can be done on or before the specific day in the future. Right. So for option contracts, owner of the option purchaser or holder have long position in option, can choose to exercise the contract if it would be profitable based on the current market situation. Seller, option writer, short position, must fulfill requirement of option buyer. Okay, so these are the example of option contracts. We have European versus American options. European option can only be exercised at maturity. European punya style. Maturity je boleh buat. American tak, can be exercised at any time before maturity. So for option ada dua juga. We have call option and we have put option. So call to buy. So logically macam mana nak differentiate buy and sell ni. Call, when you call something, you want something, you want to buy something. So call option is to buy asset at a predetermined price called the strike price before or on specified date. Put, you want to sell. So tadi call, you want to buy. So right, but not the obligation to sell. Remember, it is a right, bukan obligation. So ada hak, can do, can exercise or choose not to. Nama pun option to sell the underlying asset. So itu put. So here for call option ni, the holder has the right but not obligation to buy. And he will do so only if buying is beneficial to him. Whenever the price of the stock is above the strike price of the call option exercise, the option is profitable for the holder and the option is said to be in the money. So the writer of the call option must fulfill the contract by selling the shares if the holder choose to exercise the call option. Okay, so this is option contract. So this is the features and basic illustration for call and also put option. So for example, for call option, we have June 2021 call option on 100 shares of Maybank stock at the strike price of RM8. So if you are the option holder of this Maybank stock, have the right to buy 100 shares of Maybank for RM8 prior to the final trading day. So in this case, the third Friday of June 2021. So for put option, okay, let's say same date, June 2021, put option on 100 shares of Maybank stock at the strike price of RM8. Remember, call tadi nak beli, put tadi nak sell. So this holder have a right to sell at RM8 per share. So bila dia nak jual, dia akan dapat profit kalau the price falls below RM8. Okay, so this is the option. Nak buy boleh, nak sell pun boleh. You have the option, the right to buy or sell. Alright, so here for call option, nak buy, investor buy a December KLCI call option with exercise price of 1,000 points and cost 25 points. And as option buyer, he will need to pay the premium of 25 points to option seller. So if index move up to 1,100 points in December, will option buyer exercise the call option? Alright, so for KLCI ni kita tak pakai ringgit sebab dia adalah composite index, so kita pakai points. Strike price dia 1,000 points, cost 25 points. Okay, so the question, if index move up to 1,001, nampak exercise price dia 1,000 points, move up to 1,001, will option buyer exercise the call option? Call to buy. So if index move up to 1,100 points in December, option buyer will exercise the call option with strike price of 1,000. So option seller must provide the share by buying at a higher index in Bursa Malaysia Stock Exchange. So dia akan exercise. Compared to dia beli terus pada masa harga naik ni, 1,100 ni lagi mahal more expensive. But now the strike price dia 1,000 and cost to 25 points. So option seller must provide the share by buying at a higher index in Bursa Malaysia. So what happened if index drop to 990? The strike price is 1,000. What happened kalau index drop to 990? Option buyer may choose not to buy or sell. Sebab dia ada option kan? Kalau tadi, okay lah. Dia goes up. So they will exercise. Kalau harga point tu turun, choose not to buy or sell the underlying instrument or commodity. So let the option expire with a price call premium. Okay, so dia biar je, tak payah buat apa-apa pun boleh. So the difference between futures and option. So futures obligated to complete the transaction, wajib, because you enter into agreement kan, nama futures contract, you enter into agreement, mesti complete the transaction. For option, only writer is obligated to the agreement, the seller. Yang beli tak apa, because here you see, the buyer tu not to buy or sell, tapi the seller have to sell. For futures contract, no premium is being paid by the seller and the buyer. But for option, buyer pays the writer or the seller the premium. So dia kena bayar. Sebab tu tadi, if you look at the example here, ada 25 points. This is the price that they have to pay to the seller. Untuk futures tadi tak ada, no premium paid. Whatever price yang dia dah janji, that is the price lah. Alright, so this is very important, the differences between forward and futures. So we can see here, it's for forward tadi, if you go back to the notes yang awal tadi tu, it is an agreement between two parties to buy and sell at a pre-agreed future point in time, which can be any kind, which is more flexible for forward contract. For future contract, standardized contract, different ini agreement je, tak ada standardized. Ini standardized contract, traded on a futures exchange to buy or sell certain underlying instrument at a certain date in the future at a specified price. Structure and purpose, customized, ini tailor-made lah, forward No initial payment required, usually used for hedging. Futures tak, it is standardized. Initial margin payment is required, usually used for speculation. Transaction method, negotiated directly by the buyer and seller. This is OTC. For futures, quoted and traded on the exchange. Market regulation, not regulated, suka hati kau apa nak buat dalam ni. But for futures contract, it is government regulated market. So the institutional guarantee, just the contracting parties lah, parti yang beli, parti yang jual. But for futures contract, the institutional guarantee is the clearinghouse, Bursa Derivative Clearinghouse tadi. What about the risk? Okay, forward contract, high counterparty risk because it is open, it is not standardized. But for futures contract, low counterparty risk because everything is standardized. So guarantee for forward, no guarantee of settlement until the date of maturity. Only the forward price based on the spot price of the underlying asset is paid. Now, but for future contract, both parties must deposit an initial guarantee. Contract maturity, forward contract mostly mature by delivering the commodity. Forward future contracts may not necessarily mature by delivery of commodity. Because remember, future contract tadi depends on the future price, guys, so it can change anytime. But for contract maturity, for forward ni, mature by the delivery of the commodity. Expiry date, depending on the transaction. Futures, standardized. Pre-termination, opposite contract with same or different counterparty. Counterparty risk remain while terminating with different counterparty. For futures, opposite contract on the exchange. So contract size, again, depending on the transaction of the requirement of the contracting parties, because this is tailor-made. For futures contract, it is standardized. All right, so these are the references and the websites that you can go to read, especially on derivative market. You can go to Securities Commission and also Bursa Malaysia websites. I have prepared a few questions for your own self-test. All right. Okay, so for this one, you can refer back to the notes just now when we talk about exchange traded and also over the counter. So I want you to try to decide. For example, when we talk about exchange traded, tadi kita ada futures kan, over the counter kita ada forward. Exchange traded, we also have options tadi. And for example, active and liquid secondary market, yes or no? Traded at a centralized marketplace. Payment of margins required. Contract specifications can be tailored to the needs of the user. Used as a hedging instrument. Yes or no? Right. So for example, kita tengok for exchange traded, active and liquid secondary market. What do you think? For exchange traded, is it active and liquid secondary market? Yes or no? What do you think? For exchange traded, does it have active and liquid secondary market? Yes, no? Ainin, what do you think? Yes or no for exchange traded?
Yes.
All right, yes, and because it is exchange traded on bursa derivative, so they have active and liquid secondary market. What about over the counter? Hafsah? What do you think? Is it dia ada active and liquid secondary market tak for over the counter? Hafsah, you there?
Yes.
All right, for over the counter, no, because it is not exchange traded, so dia tak ada secondary market. It only involve the two parties tadi tu, so dia tak boleh pergi ke exchange. So for the first one, active and liquid secondary market, yes for exchange traded, no for over the counter. Alright, number 2, traded at a centralized marketplace, yes or no for exchange traded? Senang je ni, anyone want to try sebelum saya panggil nama? Tak jawab yang senang, nanti saya panggil nama, jawab yang susah lah. Anyone? Najmin, yes or no for exchange traded?
Yes, Doctor.
Okay, over the counter? No, so because for exchange traded memang trade at centralized marketplace lah, which is bursa derivative. Over the counter tak ada. Payment of margin required? What do you think? Noreza? Noreza ada?
Yes, quite.
What do you think? Yes or no?
Yes.
Okay, yes for both. Payment of margin required for both exchange traded and also over the counter. All right. Shah Nabil. Contract specifications can be tailored to the needs of the user. Yes or no for exchange traded?
No, Doctor.
Okay, no. Over the counter?
Yes.
Yes. Alright, because exchange traded, contract dia bukan tailor-made, contract dia standardized. Use as hedging instrument. Which one can be used as hedging instrument? Exchange traded, over the counter? Siti Nuraisha, what do you think?
Exchange traded.
Exchange traded, okay. Both can be used as hedging instrument, dua-dua boleh. Alright. Okay. So kita dah tengok jawapan dia tadi. So ada yes no ni. I hope you right. Next one. State whether they are true or false. Okay, baca dulu. So local participants are not participants of Bursa Malaysia Derivative Berhad. True or false? What do you think? Itu kesalahan ni. Tashini, what do you think? Tashini, you there? True or false? Tak ada Tashini, anyone wants to try? True or false? A ni. Okay, what do you think, Tashini? True or false? You cannot switch on your mic, you can type here. Is it true or is it false? Local participants are not participants of Bursa Malaysia Derivative Berhad. Mana Tashini? You said you're okay, false. Yep. So local participants are also participants of Bursa Malaysia Derivative Berhad. Okay, B, option contracts are available for all futures contract traded on Bursa Malaysia Derivative Berhad. True or false? Okay, no problem. Nurin Jazlina, what do you think? True or false, B? Tembak je lah, true or false je kan? Is it true or is it false?
False.
False, okay, betul tembak. So option contract are available or not available for all futures contract. All right, C, the underlying instrument of crude palm oil futures is palm oil. True or false? Rufina, true or false? C, true or false?
True.
True. Salah lah. CPO The underlying instrument for crude palm oil futures is crude palm oil, not palm oil A different thing Right, so C is also false. D, trading participants of Bursa Malaysia Derivative Berhad must be clearing participant or have an arrangement with the clearing participant to clear its trades. Okay, panjang yang ni it is true So all the trading participants must have arrangement with the clearing participant to clear its trades. So true. Kita tak ada buat detail on associate participants. So here, those are individuals who execute trades on their own behalf. So associate participant ini, the answer is false untuk E ni. Alright, last one. Okay, ni panjang sikit nak jawab. 3 reasons why speculators are attracted to the derivative market. Okay, why do you think speculators attracted to the derivative market? Go back to the definition of speculators and who are they, what they want. One, Khairul, what do you think? Give me one reason why you think speculators are attracted to the derivative market. Ada one, Khairul? You there? Tak ada, pergi makan lemang lah. Who else? Ada, okay, Mike tak ada one. So what do you think? Give me one simple reason lah why you think speculators are attracted to derivative market. Alright, so we can go back to the definition because speculator, they wants to make profit. So we can say that derivative market ni overall we can say that the transaction cost is low. So low transaction cost, they can also have high return. Also easy access to market. It does not limited to only big players. Small players pun boleh involve. So easy access. Anyone can access the derivative market. Even you and me. Easy access, low cost, high return. High level of liquidity juga. So easy to enter and exit the market pun. Right, that is for speculators. What about arbitragers? Under what circumstances do arbitragers enter the derivative market? Arbitragers tadi, when you look at the definition, so they are doing the buying and selling simultaneously, kan? So when they do the buying and selling simultaneously, they enter the market when they are, we can say that there are distortions or inconsistency in price. So if there is an inconsistency, okay, they boleh enter into the market lah sebab dia arbitrage, so dia akan buy and sell simultaneously. Okay, so ini tadilah why speculators attracted to the derivative market and also arbitragers enter the market when there are distortions or inconsistencies. Okay, yang ni tak payahlah, intermediaries ni saya tak cover pun. And regulatory body is actually Securities Commission. Ini CMSL kita tak ada, saya tak ada explain in detail lah, who are actually the holder of CMSL ni. Alright, that's basically the end of it for derivative. But I think I will share a few readings for you to read more on, because if you look for derivative book or financial institution book on derivative market ni, they sometimes differentiate. They discuss satu on futures derivative, satu on forward, satu on options. So very detailed. But here I just want to introduce to you what do we have in derivative market in Malaysia, and what is the concept of derivative market ni, what are the product and also the underlying instruments, and as well as macam tadi lah, I show you the table ni, the difference between forward and future contract, the difference between futures and option contract, so that you can understand. So kita tak ada buat sampai detail of the calculation lah. But if I can find a simple calculation for you to try, and then I will share later. Alright, okay. Any questions so far? I have a few questions, and nanti I think I will share later, and kita boleh try buat in the next class nanti. And now I'm still marking your midterm exam. Cuti raya semua benda pun lupa. I was supposed to mark before the break. So if you have no question, tak ada soalan? If you have no questions, okay. Next week, ada one of the days bulan Mei ni kita ada public holiday lagi kan? But I don't think it's on Tuesday. 16. 15 Mei besok day. 15 Sunday, so bawa Monday, tak apa. Monday kita tak ada kelas. So Tuesday class will resume as usual. Okay. Right, if you have no questions, thank you everyone. I will see you next week. And don't forget to attempt your capital market quiz. Pukul 4 nanti, now tak ada lagi. Kita tunggu pukul 4 baru ada. Alright, thank you. See you next week.